everyone, how's it going? In this video, we're going to talk about one of the most intriguing tech companies that has been trading on the Nasdaq, Nikola Motor. It has been one of the rising stars back in the 2020 era when the EV seems to be unbeatable and on the verge to take over the universe. This is obviously not how things have really played out, and today people are left wondering whether there is any possibility for Nikola to recover its former glories. So, in this video, we're going to talk about Nikola, the recent price actions, the technical aspects, and the best trading approach given the circumstances. Before the video begins, if you'd like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Over the past few days, Nikola has seen an increase in volatility in its price action, which is only logical given the current market conditions along its specific realities. Overall, Nikola has been trying to put its past behind it, but the market stakeholders seem to have fixated at this very past, without really looking at the future, or rather, they don't believe that there will be much of a future to speak of. According to some analysts online, Nikola has a significant probability of eventually declaring bankruptcy if it runs out of cash. In fact, maybe not if, but when it runs out of cash. Indeed, Nikola has been plagued by internal and image problems ever since the resignation and also now the conviction of its founder and former CEO, Trevor Milton, and the supply chain issues that have slowed down the progress of the vehicle rollout. It doesn't necessarily mean that there is no progress that has ever been made, but it's rather difficult to make the case to say that the company has been able to secure its future. Things have been going on far too slow for the market to take notice of them or to give them any significance. Nikola has also raised capital several times over the course of the past 12 months, which also put additional pressure on the share price. It is also facing the possibility of being delisted from the Nasdaq because its share price is now below the $1 unit per share, which is, the minimum required for any title to remain listed on the Nasdaq. So with that being said, Nikola is now considered to be a penny stock with a high volatility and also higher institutional participation than many other stocks, surprisingly enough. We can reasonably say, therefore, that we may see some interesting opportunities in the years to come bubbling up, assuming that it continues to stay around. With that being said, here's a look at the technicals. The trading volume of Nikola Motors has recently been around 163 million shares, compared to an average volume of 115 million shares. Over the previous 52 weeks period, the price fluctuated between 52 cents and $3.71. The volume of shares traded tells us how many shares have been bought and sold at any given point in the market, and if there's enough liquidity to support a trading strategy. If the float is thin, it would be very easy to influence the stock price, but low liquidity could mean that the demand is limited as well. When we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough if the difference is very large. For instance, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of Nikola Motors is currently around $840 million. As we compare the current price to the historical price fluctuations, the stock is 40% higher than the 1-month low, 40% higher than the 3-month low, and 78% higher than the 52 weeks low. On the options market, which also gives us a hint about the market sentiment of where the stock may go next, the implied volatility is around 131%, compared to a historical volatility of 116%. The put-call volume ratio is currently around 30%. It is normal for most stocks they also tend to have a higher put option volume than what they deserve, because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 67,000 contracts a day versus the 30-day average volume of 87,000. Regarding the open interest, the most recent volume of open interest is about 2 million contracts versus a 30-day average of 1.8 million contracts. In terms of the shareholder structure, institutional shareholders own 24%, which is quite significant given the scale and history of the company. The biggest shareholders include Vanguard, BlackRock, and Citigroup. Usually, it's always good to see some institutional participation when holding a stock long term, because it offers a layer of stability and a token of reliability in the medium to long term. It means that the market is confident that it will deliver value in the long term, which is an important factor to consider for the investors. I personally consider the minimum threshold to be around 25 to 30% for institutional ownership if I want to hold a stock long term. The current short interest is about 20% of the total float, 50% of which from the dark pools. Usually, if there is a short interest above 15% with a significant chunk of it from the dark pools, this may suggest the presence of short operations with potentials for short squeeze. So in this case, I would say that there is a moderate to medium degree of potentials for short squeeze. And given the company has every incentive under the sun to go above the $1 level, it's not too surprising if we see some sort of sudden surge, whether it lasts or not. However, I don't believe that this should be the sole reason or even the main reason why you want to buy Nikola, because at 19%, it's just 4% above the typical threshold, and I don't believe that it's really uncalled for or unjustified. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and declined quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflation. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties and social unrests will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So, really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. Overall, I believe that Nikola is a decent stock to include into your trading portfolio as a short-term speculative position. There should be a high risk appetite and reward to be expected, and the exposure should be controlled within a reasonable range. So I would recommend to commit between 0.5 and 1% of your portfolio in Nikola, and to split the allocation in 20% at a time over the next 3 to 6 months to purchase more in case of further retracements.